Good evening, everybody. So as Fred said, it's a very sort of beginners level, just aimed at people that are just getting started out, just to give people a few of the basics of how these things work. The sort of things that I'm going to talk about are the different ways that you can approach this. So the different legal structures. You can be employed by a company on an ad hoc basis. You can operate as a sole trader, or you can operate as a limited company. I'm going to touch on the implications of being VAT registered and when that might be a good idea or a bad idea for you. I'm going to talk a little bit about IR35. This is a hot topic at the moment as some of the rules are changing, and then there's going to be a little bit of time for some questions following that. So as Fred's already introduced me, I'm Chris Timson. I've been freelancing on and off in various capacities across various industries since the last millennium, and it seems like a long time when I think back to sort of 96, 98, whenever it was that I started doing these things. I'm not an accountant. So what I'm here to speak to you about is the knowledge that I've built up over 20 odd years. It's very broad brush. Do take things face value. Definitely get some advice with what you're doing. But the idea is just to give you a few pointers about the right direction to be thinking in with these things. So a few things that I'm going to ignore for the purposes of this evening, in order to do some sort of simplified comparisons and things. There are various different ways that you can pay tax. So you could be paying it weekly, monthly, annually, and those various things can affect the rates and the way that you pay things. You could have student loan contributions if you've been to university, and that could affect your tax strategy and the way that you want to approach things, the way you want to structure things. I'm going to ignore that. Pensions, we've got workplace pensions these days. I'm going to ignore all of that. That's another thing that you might want to factor into your tax planning and the way that you do these things. Your age, everybody here looks nice and young, but if you're actually in the older end of the scale, then there are some tax changes there. Same thing if you're married. There are married person's allowances that you can use to structure your taxes and things. I'm going to ignore expenses. Obviously, it's important that you find as many things as possible that are legitimate expenses to offset your income and to reduce your tax bill, but I'm going to ignore those. If you're based in Scotland, they have a slightly different tax regime up there. I'm going to ignore all of that. Since we're in London and we're just going to focus on UK stuff. You may have an unusual tax code. There's a standard tax code, which is what applies to the sort of default person with no complicated circumstances. But if you've previously earned money that's being paid on a tax bill, or various reasons that your tax code could have been changed, then that may influence the way that you want to structure your freelance work to offset these things. I'm going to be looking at profitable companies. So a lot of the things that I'm talking about are relevant if you're in a startup and you're doing something innovative. Perhaps you've got a bit of investment money and you're using that to pay yourself. If that's the case, then it's perfectly valid to run a company that's not profitable, as long as it's for a limited amount of time. But you'll approach taxes differently if that's the case than what I'm talking about here, which is aimed at freelancers. So the assumption is that you're going to be bringing money into the company. You're going to be working for other people and bringing money in on a regular basis for doing that work, rather than something where you're researching a product for the future and the money is hopefully to follow. I'm going to ignore the concept of minimum wage. Something you definitely need to take into account when you're employing people, but there's a bit of flexibility with that when it comes to employing yourself through a company that you might be running. And there are various tax credits that come into play. So potentially, if you're running a company, there are things like R&D tax credits. As an individual, there may be tax credits and things, but I'm going to ignore those for the purposes of keeping it hopefully fairly sort of slick and quick and sort of broad brush. So the first way of approaching these things is that you could become an employee. So you could work for a company, assuming that they're running a payroll scheme. They could take you on as an employee, stick you on their payroll, and they deal with all the tax side of things. The money that you receive is yours to keep. Do with it as you wish. Nice and simple, nothing really to worry about. You don't need to keep any accounts. not necessarily the most tax efficient approach to these things. So the other approaches that we look at, the simplest way to get started, if somebody says, I want you to do some work for me, and you want to get started on day one, is that you could become what is referred to as a sole trader. This has no legal distinction between the business and yourself. This is you operating as an individual, as a business, and there is no legal distinction. But the good news is that you can start on that straight away. You don't even need to tell HMRC before you start. You have a period of time where you can tell them about things, and you can transition between different ways of working. So it's a default kind of quick way of getting up and running. More commonly is to approach things as a limited company. So a limited company is a separate entity. It is often seen as being more credible. Definitely if you're working with larger organisations and corporates, they may require you to be operating through a limited company. So we're going to talk a bit more about those because it's a common approach to these things, and it can be a tax efficient way of working. And then there are various other company structures that I'm not going to talk about at all, such as CICs, which are community organisations, partnerships, which are effectively sole traders with more than one person, limited liability partnerships, co-ops, and limited by guarantees, which are non-profits. Ignore all of those because they're not relevant to, hopefully the audience here is a bunch of freelancers, but they are other legal structures that you could use in order to operate as a company. So effectively there are different approaches that you can take. The two that I'm primarily going to talk about are sole trader versus limited company. The graph here is a bit of a demonstration of the amount or the percentage of tax that you're paying by approaching things either as a limited company or either as a limited company or as an employee. And this is the reason why a lot of people elect to operate as a contractor, through their own company, rather than becoming an employee of effectively your client. So you can see here that the benefit does diminish over time, but you can see from the graph that there's a continued benefit to handling things yourself. The other benefits not shown here because I've said that, sort of ignoring them. Obviously there are potentials for expenses and things like that you can potentially offset by doing things yourself. Flip the graph so we look at it from a different angle. This is effectively how much of the money you get to keep for the two different ways of doing things. So as an employee, as you can see, it dips below the 60% level there, and as operating through a limited company, you get to keep slightly more of the money. So the most common way of people working is to incorporate a limited company. By doing this, you potentially, depending how you manage things, can get several tax advantages. Effectively, you're creating a new legal entity. So in a similar way to giving birth to a child, you're creating something that is no longer you. It is another legal entity, and assuming that you're operating as a sort of one-man band, you then become both the owner of and the director of that company. So as the shareholder, as the owner of the company, you are it's yours. You possess it, and as director, you have the responsibilities for running it. One of the common misnomers that people make with limited companies is the expression of limited and what limited liability means. So effectively you've got two different things. As the owner of the company and as the director of the company, they are, for one-man bands, often the same thing, but they don't have to be. So limited liability provides you with protection for the shareholders, the owners of the company. So if you are operating as a sole trader, there's nothing that distinguishes your business from you as an individual. So potentially applies some risk to you there. A limited liability company provides protection for the owners of the company, the shareholders of the company. So if you've bought shares with a nominal value of £1, the most you can lose from that company is £1. Unfortunately, and this is where I say you need to be careful in making sure you know what you're getting into, it doesn't provide the same level of protection for directors of the company. So if you screw up as director of a company, you're not protected by the limited liability. So things like misfeasance and malfeasance, which are subtly different things, are effectively bits of legislation that can be used that if you screw things up as a director of a company, then you can still get into some bother and end up with some liability for that. The benefits of limited companies are that you have the ability to pay yourself via slightly different ways of doing things. So by using a combination of a salary and dividends, potentially you get the tax advantages that I spoke about earlier. And that's going to be different for everybody, different situations. So it's definitely something where it's worth looking at the numbers and working out the scheme of things here. As I said, there are liabilities that can be incurred either from operating as a sole trader or as a director of a limited company. So a good thing to consider is insurance to offset these things. You'll find plenty of insurance brokers who will tell you all about the hundreds of different insurances that they can offer you. I'm going to talk just briefly about a few of the key ones that I think are worth considering. Certainly speak to an insurance advisor about the others and see what they say, but also take into account that they're there to sell you insurances. So the first one that a lot of people will require you to have, especially if you're operating on their premises, on their site, is public liability. And in effect, this is people having accidents as a result of something that you've done. So if you're on a client's site and you leave a cardboard box in a corridor and somebody trips over it and breaks their leg and they decide to sue you, then that's public liability. It's protection for things that might inadvertently happen to people. Professional indemnity insurance is talking about if you have acted incompetently in some way in terms of what you're doing. So if you were writing some software for somebody and the software didn't perform as anticipated, and they decided that this was something that they wanted to take action against you for, then that would be where professional indemnity insurance would come in. That protects you against effectively professional mistakes that you've made. So less on the accident side of things, more on the how you've carried out the work. The other one that may possibly be worth considering is the director's liability side of things, and that's protecting you against the any mistakes or anything that you potentially have problems with on the in your carrying out of the job of a director. So in terms of the accountancy side of things, there are going to be various things that you have to pay. The obvious one is income tax. I've touched upon dividends already, so this is where as a limited company you can use dividends, which is a sharing out of the profit that the company's made. And then another key one that comes into play is national insurance. So if you are employed by a company that you own, if you are on the payroll for the company that you own, or you're acting as an employee, you get an allowance every year. Currently is £8,632. So this is in the same way that you currently have a £12,500 tax allowance. You get an allowance for national insurance of £8,632. Earn above that, and that starts to kick in at that point. If you're operating as a sole trader, then national insurance cuts in for some bizarre reason at a different level. It's £6,365, and this is one of the many reasons why people opt to do things as a as a limited company rather than sole trader. Another one being that people often take acting via a limited company as being a sort of an extra level of credibility, perhaps because they're slightly more involved in setting it up, but there are tax advantages to that. Something that a lot of people forget about or skip over or don't realise is the way that national insurance is added up. And it's often something that accountants seem to miss as well. And this is that the way that you pay tax is that all of your income is added up. This is what a tax return does. You add up all of your income, and your tax allowance, currently £12,500, is taken off all of your joint income added up. And then you then apply your tax rate to that. It's worked out across all employments. If you have multiple jobs, if you do a bit of freelance work on the side. What you can, however, do is take advantage of the fact that national insurance works on a per job basis rather than per person basis. So you have a £12,500 tax allowance, but your £8,632 national insurance allowance is per job. So if you have 2 jobs, you get 2 allowances. If you have, if you were to do some sole trader work on the side as well as having a main job, your sole trader income would give you that £6,365 allowance on top of the £8,632 you'd get in your main job. So this is something that is worth considering, is that if you are involved with multiple companies or you're doing several different things, is that it can work out advantageously from a national insurance point of view. It's, they're allowances. It's not going to massively add up, but it's something that's potentially worth considering, depending on what your individual situation is. The next thing I'm going to talk about is VAT. VAT is a value-added tax. It's a tax on the value that you add to things. So it's a tax on the difference between what something costs you and what you sell it for. So if you are selling widgets and you buy them at price A and you sell them at price B, the VAT that you add on to that is the differential between them. As freelancers, the thing that you're selling is your time. You don't buy your time, so you don't get to claim back any VAT on it, and therefore VAT is applied pretty much on the whole of what you do. VAT is something that you don't need to worry about until you reach the threshold. It's currently £85,000. So if you're below that threshold, it is something that you can forget about. However, you may decide not to. And the reason for this is that it's worth taking into account the VAT status of your clients. So if, let's say, for example, you're a painter and decorator and you paint people's houses, your clients are people. They can't claim back the VAT, so the VAT is a thorn in their side. It's if you are charging £100, you've got to add the VAT on, it's 20%, £120. Your client, Mr. Jones, that wants his room decorating, has to pay the £120. You only get to keep 100 of it. So if you are dealing with members of the public and organisations that are not VAT registered, then it is to your disadvantage to be VAT registered. However, I'm assuming that probably if you're freelancing, you're largely going to be working with companies. Those companies are probably going to be VAT registered, and if they are, it's of no bother to them whether you charge them VAT or not. So if you are doing a project for a client and you are charging them £1,000, if you are VAT registered, you will invoice them for £1,000 plus £200 of VAT, and they will pay you the £1,200. You keep the £1,000, you pay the £200 to HMRC, they claim it back, and nobody really cares. The benefit of being VAT registered is that it allows you to claim back VAT on things that you buy. So if you were, for example, to buy a laptop, you pay £3,600 to Apple, you get to claim back £600 of that. 1/6 of that money comes back to you. and you can claim that back. So it is worth considering potentially registering early if you are if your client base is VAT registered. Something worth taking advice on. Some people say that the problem with being VAT registered early is the record keeping. My personal opinion on this is that the record keeping for VAT is not particularly onerous, especially if you're using modern software packages that are a good idea for tracking your accounts. Then the record keeping that you need to do for VAT is probably good practice for business in general. Whether you're a sole trader, a limited company, whether you're registered for VAT or not, it probably makes sense. So the next thing I'm going to talk about is IR35. This is HMRC code for what they term off-payroll working, and is effectively a set of rules designed to prevent people from becoming what are referred to as hidden employees, effectively setting up your own company and providing services under a contract in order to try and get your tax bill down in the way that I mentioned. The rules came into effect in about 1999, 2000, somewhere around then. They've not changed particularly. The rules are mostly the same. The current reform that is happening with IR35 is not really changing the rules. It's changing who is liable for who's liable for deciding whether or not you are liable for whether you fit under the IR35 rules or not. The reform took place for the public sector a couple of years ago in April 2017, and it was considered successful. I think HMRC managed to raise some more money through it, so they are bringing it into play for larger private sector clients as of April 2020. It's not happened yet. Obviously, we've had a bit of political change recently. We've had a general election. We've had a recent shuffling of cabinet in the last week or so. So who knows? Might not happen. It looks like it is going to happen. But this is something where if it is probably going to affect you, you probably should have spoken to your clients and discussed it with them by now. It doesn't apply to smaller customers, so it's only applying to medium and larger companies. So if you've got less than 50 staff, I can't remember the other numbers, 5 million of turnover, those sorts of things. If you're a smaller company, or if your client is a smaller company, then the reform of IR35 for the private sector doesn't apply. It only applies to larger companies, so big corporates, anything of that sort of size. In theory, it also applies to international clients. So if you're working with clients outside of the country, then supposedly the theory is that IR35 applies there as well, although it's difficult to see how exactly they're going to apply that. The idea of the reform is that it's very difficult to chase after individuals, you guys, the freelancers out there, and if say a corporate has 1,000 different freelancers working for them, it's much easier to approach the corporate and try and figure it out across all of their freelancers than it is to try and track down and work with each of those 1,000 freelancers. So that's the reason for it. The benefit of the reform as freelancers is that it takes the liability away. So previously, if you were a freelancer, the question of whether you fell within the rules of IR35 or not was down to you to decide. And if you got it wrong, you're liable. So if it's deemed that you've avoided tax and that you need to pay this, then it would be you that would be paying the back tax, the missing tax. The new rules, the reform, makes that the responsibility of your client. But as is the case often with larger companies, they can be quite risk averse. So there is a potential for clients to err on the side of caution and decide that people are to be taxed as employees rather than as a company. It is something that you can dispute. Again, because the reform is quite new, the jury's still out as to exactly how those disputes work. But one of the key things to consider if you're having conversations with people is the Inland Revenue's CEST tool. And this is check employment status for tax. It's a tool on the HMRC website. It's really easy to find with Google, so I won't bother providing you with a link for it. But effectively, it asks you a whole bunch of questions about, so the IR35 applies to each individual contract that you may have with a client, and it is applies to each one, and you can go to the tool, you can enter in details of or answer the questions that they ask about your particular contract, and it will give you a determination. It will say that HMRC believe that you are affected by IR35 or you're not. Various people saying that the tool isn't fit for purpose. It's not the best tool, but it's not actually too bad, especially not for HMRC. One of the key things is that HMRC declare that they will stand by the result you get from the tool. So they say that if you answer questions honestly on the tool about your situation as it stands, at the end of the tool you've got the opportunity to print out the details of the determination it's given you, and you can use that as proof of your IR35 status. The thing to bear in mind is HMRC see themselves a bit as an authority on these things. The fact that they say that they will stand by the results of the tool mean that if the tool says you're outside of it, you're outside of it. They're not going to pursue you for that. If it determines that you're inside it, it doesn't ask you to fill in any details when you use their tool, so you can have a play around with it. You can go in and say, well, what happens if I answer this question differently? What happens if I try changing this? And then obviously you can negotiate with your client to actually make sure that your contracts fit in there. A thing to bear in mind is that effectively it would be the courts that would decide whether you were inside or outside of IR35 rather than HMRC, but they like to throw their weight around and see themselves as an authority figure on these things. And to be fair, rather than have a court battle, it's probably easier to find ways to make their tool say, yes, you're compliant, big thumbs up, it's all good to go, rather than trying to have a legal battle with them. So some of the things that the CEST tool will ask and sort of take into consideration, one of the first questions it asks you is, are you an office holder of the company? So are you effectively acting as director of the company? If you are, you're probably looking a bit like an employee. So it's something that they would err in the direction of you being an employee rather than a contractor. Probably the biggest one is substitutes. This is effectively saying if you're providing a service rather than being an employee, can you put somebody else into the job instead of yourself? Can you send somebody else in to do your job instead? An employee can't do that. An employee can't send somebody else in to do their job. But as a contractor, you're a company providing a service to them, and therefore, in theory, you might want to send in one of the other members of staff rather than yourself. This is something that typically clients are probably averse to because they've built a relationship with you. You're the freelancer. You're doing the job. So the idea of on Wednesday I might say, oh, I don't fancy working today, I'll send Fred instead, is something that doesn't sound that great, and therefore they're unlikely to be all that amenable to the idea of including a substitute clause in their contract. But the interesting thing is that HMRC say that it's fine for there to be clauses that say you can provide a substitute, but they need to be qualified, interviewed, vetted and security cleared. So you can have a clause that says it's okay, I'm a freelancer, it's okay for me to send somebody else as long as they're somebody that you've approved of, somebody that you've already met, they're qualified to do the job, you've already interviewed them, they've been through your vetting process, they've probably got a security badge already for the building, they're somebody who effectively is somebody that they already know anyway. So on that basis, that I think makes it very easy to add a substitute clause in, and potentially is a good way of making sure you sit on the right side of the IR35 argument. Another thing they ask you about is alternate tasks. So this is the idea that as a subcontractor you will often be brought in to do a very specific job. Employees are often asked to do all sorts of random things, and an employee probably will struggle more if you say, oh, could you just do this for me, they're in a bit more of a difficult place to say no, whereas a contractor potentially can say, no, that's not what I'm here for. So the idea that you can turn down things that aren't what was agreed that you'd be doing makes you look more like a subcontractor or a proper contractor. The location of where you work is something that they take into account. So if it's, doesn't matter where you work from, we just need the job doing, you're looking more like a contractor. If it's that desk over there is yours, we expect you to sit at it from 9 to 5, you're looking more like an employee. There's no hard and fast rule with all of these things, but it's definitely the more that you can look like a contractor, the easier it is to argue that. The equipment that you use, it's often considered that contractors will provide their own equipment. Bizarrely, in the tool here, HMRC say that laptops and tablets and phones don't count as equipment. So the fact that you're using your own laptop, they don't deem to be providing your own equipment, which seems like a strange one to me. But bizarrely, they also seem to ask questions there about when things are being paid for. So for example, they say if you pay for your, let's say you've got a vehicle, you've got a car, and you drive it and then you bill them later, that makes you, in the eyes of the CEST tool, look more like an employee, look more like a contractor than an employee. Now, don't really think that makes sense, given that often employees will drive the car and stick an expense claim in for it later. So it's a bit of a strange one, and I think this is probably where a lot of people are saying this tool is not really fit for purpose, in that it has some bizarre foibles. But it seems to me that rule is to your advantage. Things like travel and accommodation. So if you're traveling to client sites and if you're working away, you're putting up your own accommodation, makes you look more like a contractor. If they're paying for it, potentially more look like an employee. Any benefits the company might provide. So this could be things like gym membership, gym access, private health insurance. Things like, it could be as simple as things like an invite to the Christmas party. There are certain benefits and things that make you look more like an employee, certain things that make you look more like an outsider. There are a whole bunch of other questions that it asks. Similar to the first question, management responsibility. Are you a manager of the company? Are you managing other people, or are you just there to get in, get a job done and get out? Other clients, other work. Are you just working for this one client? If you've got one client and you spend 9 to 5, Monday to Friday working at one particular client, you look a bit like an employee. If you say, well, actually I do, every other Tuesday here, I do some other stuff for this client, that client, and it's all in a similar line of work, then you're looking more like a client, and more like a contractor who's providing proper contract services. And one of the questions they ask is about other clients that you've had in the last 12 months. If you've been working consistently 9 to 5, Monday to Friday for the last 18 months in the same place, you look a lot like an employee. If actually you've done a month here, a month there, you've done every Friday at this particular place, and it's all a bit mixed up and it's all a bit ad hoc, and there's no commitment from you to work for them, and there's no commitment from them to provide you with ongoing work, then you look more like a contractor. So that's pretty much most of what I've got to speak about. One thing that I think is good advice for anybody on this side of things, there's plenty of accountants and things out there that will obviously give you advice on these things. There's a ton of information online that you can research. Some of it's wrong. Some of it's very misleading, as with everything on the internet. One thing that I would recommend is mentoring. I would say, if you can, find yourself somebody that's been through all of this before. Find yourself somebody that can help you out when you've got a few questions. It could be somebody that's helping you out for free as a friend. It could be somebody that you're paying for their time to mentor you. But I think mentoring is a great way of avoiding solving problems that people have already figured out before. So that's pretty much a summary of what I've got to speak about. Any questions?